welcome to this episode of Great Quarter Guys. We have an action-packed show for you today. My name is Kevin Hill. I have my co-host over here, Andrew Cox, and our special guest, JT Engstrom. And we're going to talk about M&A and private equity and trucking and logistics and kind of what's going on. You know, the market's kind of down, but, you know, what's going on in M&A, you know, private transactions, public transactions in trucking and also freight brokerage. So, and special thanks to all the research provided by our friends at Carrier Direct, Peter, Ryan, and Diane, and all the work they do for this show. So we're going to talk about M&A, and then what are we going to talk about? We're going to talk about the drug clearinghouse.
Yep, jump into that bit.
We have like some dramatic numbers coming out of there.
Yeah, a bit surprising.
It is.
Well, it's not really surprising, but they're large.
They are large. They're larger than we thought, right?
Yeah, I think we'll probably end up modeling that quicker than we thought.
I think so too.
Do it Q1, but we might have to do it after this month.
Yeah, definitely. And then we have the DHL supply chain, and then our regular long and short reports. So let's get down to it. JT, before we start off, why don't you tell us a little bit, tell our listeners a little bit about your background and what brought you to FreightWaves?
Yeah, thank you for having me on. It's my first time on Great Quarter Guys, which I'm disappointed to admit because I think this is an awesome show. So thank you for having me.
Anytime.
I think this is a riveting lineup of discussion topics we have here this afternoon.
Riveting.
I really mean that, and it'd be a lot of fun to talk through this. I'd have to echo, thanks for the contributions of the guys at Carrier Direct, and
every week they do a lot of research for us.
You know, it's interesting is those guys. So Pete and Ryan are both really sharp, and so directly interrelated to the conversation we're about to have about M&A. You know, one thing that makes the liquidity of buy-sell transactions much smoother is when you're selling an operating company which is relatively well-run. And they do a really good job of helping operating companies improve various elements of their businesses. And so they actually, play a part in this process. So
they do. They help both asset and non-asset-based companies prepare to get to the competency and efficiencies to then go out and either make an acquisition or be acquired by a larger player or a more strategic player.
Yeah, or grow healthy revenue, expand margins, diversify lines of business, think about doing things more efficiently, leveraging cross-sells between the asset side of the house and the asset-light side of the house, expanding gross margin percentage, and also think about more deeply penetrating customer bases. And all of these subjects are relevant to M&A.
It is, yes. And you have a little bit of background in M&A, is that right?
Yeah, so my background, so I spent 3 years as a management consultant at Oliver Wyman in their transportation group. That was right on the back of the Great Recession. We did a lot of operational turnaround work, and we were also hired by a lot of private equity firms to do like leverage buyout support to tack on to portfolio operating companies. And then I was equity analyst for, call it 5 years in transportation, covering trucking, brokerage, 3PL, a bunch of other stuff that we talk less about, including railroads. And then I was in investment banking doing both M&A and some public equity, a little bit of debt, but mostly M&A in the trucking and brokerage space. And so this is something I've lived from a lot of different angles. So it is a subject that I really enjoy.
And what you're an engineer by trade?
Yeah.
So by education, not by trade.
Yeah, that's a great question. So I actually started off as an industrial engineer and operations researcher, and I got into trucking or got interested in trucking and transportation because I really liked routing. I thought it was a cool kind of thought process to try to figure out.
Oh, yeah.
Not a lot of people know that, but yeah.
So routing and lanes and efficiencies in that.
Right, which parlays well into thinking about trucking companies and railroads and things of the sort.
It does.
That's news to me.
It does. Know that.
Yeah, a lot of people don't know that. So I've got a little bit of a nerd in my background.
Very good.
So
more than a little.
M&A is an interesting subject. And so when we talk about M&A and we break it down sector by sector, what you're always trying to do is craft a combination of a buyer universe and a seller universe. And typically all these universes are imbalanced.
Mm-hmm.
And so when we talk about trucking versus asset heavy versus asset light is maybe the best way to start off by segmenting it. In the asset heavy world, you have a relatively highly constrained buyer universe. Specifically in the trucking space, there's a list of maybe 50 typical acquirers. And if you do M&A in the space, all of them. They all know each other. There's a group of probably 10 or less law firms that operate in that universe as well. Same with the accountants. So it's a small fishbowl.
It is for like a $800 billion a year industry, or maybe if you say $400 billion a year on the commercial side.
Yep.
Everyone seems to know everybody.
Yeah, the pyramid gets narrow at the top.
Very narrow.
And so what happens when you do deals is you have to assume that everyone sort of knows everything about the deal, despite the fact that you might not have revealed any information. They may have already done due diligence on the company. They might already know the entire customer base. They'll likely have talked to the customer base to get insights into what the company does or doesn't do well. They'll probably already know the lenders that have the current credit facility on the asset prior to the transaction. And so they might have a different view on the financials than can be seen in the SIM, which stands for the Confidential Information Memorandum, which is more of a storytelling book that investment bankers will put out.
Mm-hmm.
So you might have an investment banker put out a book that says that, revenues are up 10% year over year and margins are expanding and this, that, and the other. And, you might also go talk to the creditors and have them be like, yeah, well, last year operating income was down 25%. They tripped one of 4 covenants. They lost their biggest client.
so they exaggerate a little bit.
It's all about storytelling. I mean, you're selling. Being an investment banker is like being a sales guy. It really is. It's a complicated sales role is kind of one way to think about it.
So why would a large trucking company, one of those 50, what's one of the primary reasons why they're in acquisition mode?
Yeah.
I mean, what are some of the 3 type of buying decisions whenever they say, yes, we're looking for acquisitions? Is it, non-organic growth? What exactly comes into play?
Yeah, no, it's a great question. And what happens is when you get really deep in this space, you'll find that, if there is 50 of each of the 50, you have to know them all really well to figure out when all of them are firing on what cylinders.
Mm-hmm.
And then you seek to time the market such that they're all firing on all cylinders so you can drive valuation.
So is there a common theme?
There are, and I'll jump into those.
Yeah.
But I think just to set the landscape,
Okay.
I think that's kind of an important background because they all have different capital and ownership structures. They all have different levers of leverage. They all have different philosophies and theses. But if I were to boil down to goals post acquisition for why they all get involved, I would have kind of like the high mountaintops being one, acquisition of a new competency. And so...
Is that like a new mode, new region, new geography?
Yeah. So Heartland acquired Interstate, for example, because Mike wanted to get on the West Coast. And then he doubled down a year after because he wanted to have density on the West Coast.
Okay.
So it's a good example where, they had overlapping customers. They had relatively same equipment type. It was acquisition of lanes effectively, and then it gave them some pricing power when they did the second acquisition. So it's a good specific example of how you can build out land density and you can gain, I don't want to use the term pricing leverage, but
you have a denser network, so you have some kind of pricing power that's above where you started out.
Or at least operating synergies to fill backhaul.
Sure.
And perhaps consolidate some terminals.
Mm-hmm.
Right? And maybe get some purchasing synergies with equipment.
Mm-hmm.
And maybe also have shared parking space and shared back office resources such as driver recruiting in Washington State.
Yeah.
So at a tactical level, and these truckers, again, these top 50 are guys who have done this their whole lives. So you talk to Mike Jardine literally in this Heartland example. I mean, his first job was washing truck tires when he was like 3 years old for his dad. Like he's been thinking about this for 60 years.
Yeah.
You know what I'm saying? I mean, he knows it well, and all these guys do. So, another good example is if it's a direct overlining operating company, it could be an acquisition of a net new customer contract. And many times, if you're looking to penetrate a large customer, sometimes it's easier to purchase a contract than to go through a bid process and to try to lose money the first year or two and figure out how to price it.
Yeah.
Because most of these contracts are all different. And so figuring out pricing is tough.
It is very tough. Yes, definitely. As someone who's tried to figure out pricing for trucking, it is all over the place and hard to figure out. And
it's really not an intelligence thing.
Yeah, no.
It's really not.
Yeah.
Because it's like, what you don't know when you're pricing a contract for the first time, it's like, okay, like, so what's actually detention and like, what is traffic really like on this lane if I've never been on it? And what's the time of day? What's the actual receivership look like? How well do they like load unload? I mean, there's all these other things you don't know the answers to.
Exactly. Now, how about acquisitions or the possibility of acquisitions to capture another trailer mode? So if you're a dry van carrier, do you want to acquire, more specialized, maybe in reefer or flatbed?
Yep.
Is that another of the top reasons to be acquisitive as a trucking company?
Philosophically, it makes sense if, and this is a big if, and this is JT's personal opinion here, if there is an adjacency within your current customer portfolio that would demand both services such that you could cross-sell it. And so let me expand on what that means. If you're a dry van truckload carrier and you have a relationship with a big box retailer and you think that by purchasing a refrigerated carrier, you can cross-sell that relationship to both equipment types, that makes a ton of sense.
And one of those would be, a perfect example that is very tangible is Walmart getting more into groceries.
Yep.
Or Target getting more into groceries. So
Great
you have a dry bulk, dry goods company that's starting to open up and expand rapidly into fresh and frozen foods. Perfect opportunity to do across that.
Strategically logical, makes a ton of sense. Now, conversely, if you have that same Walmart contract and you're a dry van carrier, it doesn't make a lot of sense for you to go out and purchase a specialized flatbed carrier because you want to diversify. And you can see historically operators had made this mistake under the guise of, well, we want to diversify, we want to have counterbalanced revenue streams, and then they find out, well, the equipment's different, the customer contracts are totally different. My operating management teams need to be fundamentally different because they're definitely different businesses, and all of a sudden I'm not getting any synergies, and I'm running two different brands, two different types of companies, and this is not... I'm not getting leverage on it.
And you can see that with if you study the conglomerates at all, especially from the 70s or 80s or even now, going out and diversifying your portfolio doesn't really, you can burn a lot of money doing that.
Yeah, you can.
It's not easy to do to get into another industry or even in the same industry, difference between van customers and flatbed customers are dramatic.
Yeah.
It's a dramatic difference between the two, and we see it now with e-commerce, right? The final mile network is completely different from the full truckload or even the LTL model.
Oh yeah, we've spoken about this, about the different service that LTL and last mile are. Like with an LTL, you're just there. You got a half a truckload. You go and drop it off. You're off. It's just about getting it from point A to point B. But there, with your final mile delivery, you have this kind of white glove service where you need to have people that have skills that can hook up a washer and dryer, that can put up some cabinets if they had to. It's just a different set of skills that people don't really think about unless you're under the service.
I think you saw that with the Schneider acquisition of the final mile and then shutting that down, is that the full truckload and final mile are two different
beasts.
They're different beasts. Wouldn't you agree, JT?
Yeah, and I think on top of that, talking about different beasts, Andrew just dropped a three-letter word, which was LTL. And that's a totally different beast than truckload.
Yes.
In the past, a few times, people have tried to merge truckload and LTL carriers for something other than just acetizing line haul, and that's created challenges more so than our previous example. But LTL businesses, if you're to talk about M&A and LTL now, that's a very different conversation.
Yes. you have a smaller pool of carriers on the top, right?
Different industry dynamics,
Mhm.
different industry economics, and now you can still do deals with those two criteria. But the third criteria is probably the most important: is combining overlapping networks doesn't really give you operating leverage.
No, it does not.
It doesn't give you a lot of operating leverage now. What you could conceptually attempt is adjacent networks to gain, head haul, back haul. The challenge we've seen is that combining adjacent LTL networks is incredibly challenging. And luckily, since deregulation, especially over the last 15 years, LTL models have been pretty price disciplined, and it's resulted in them being able to drive a lot of cash flow, and they haven't need to buy people because they've been able to organically grow at a multiple of the truckload space.
I think one of the really good examples in the last few years of the difference between LTL and full truckload is, or not Amazon, XPO's acquisition of Conway, where they took the LTL side and completely sold off the full truckload side
CFI,
of
yeah.
CFI to pay down debt, but there's no reason to have LTL and full truckload.
No, and I mean,
Especially for XPO.
no, and if you talk to the management team at XPO, they'll tell you that running a full truckload carrier, an asset-based truckload carrier, is tough. And they were able to diversify away. I think what became clear post acquisition of Conway is that truckload operation was a crutch for the LTL when it was under the brand of Conway, and effectively, the truckload division had always been criticized for running very poorly, but the reason is because it was the cost center for the LTL division, and they were hiding a lot of operational inefficiencies with Conway's LTL network, which Brad exposed and then fixed. And so that's why that deal worked for Brad, is because he had a lot of operational improvement opportunities, and he got rid of the crutches and, backfilled it with third-party relationships with expedited carriers to do team line haul, which, oh, by the way, happens to be like one of the most difficult kinds of trucking, because you've got 2 or 3 guys in a cab, they're running nonstop, they're sleeping while, doing 70 miles an hour. It's a disaster. Turnover's 200+%.
It's tough. I mean, I can imagine, driving for 10, 11 hours and then getting in the back of a truck for the next 10 or 11. I mean, that's
the job.
Yeah, that is the job. That is the job.
And you don't know the guy driving.
I know, right?
So, it's hopefully,
Might have met him the day before.
Yeah, literally.
Yeah.
That's team line haul, or expedited.
So what did we find out on the M&A volumes and sizes of deals in trucking over what time frame did you look back?
I looked back to 2000, and it really looks that the activity didn't really pick up until early this decade. So we're looking like 2013, 2014, and then it just pops off 2015 for $100 billion. And I can dive deeper into that. I'm sure there's probably one really big deal in there that inflates it a little bit. But yeah, it's just the amount of capital invested has steadily grown on a double-digit basis for the last 10 years or so, peaking in 2015.
For sure.
Yeah. So when was Knight Swift? That was 2017.
That
or
sounds
2018.
Right. 17. Yeah, about that time period. I think 17.
Yeah, late,
give or take.
Mid to late 2017. It was because it was right before the ELDs.
Yep.
In late 2017.
Yep.
Yeah.
So I mean, a couple of things come to mind when I look at this chart. We didn't talk about the asset light space, which is pertinent to this chart.
Oh, we will get there in a second.
And okay.
Unless you want to go there right now.
Well, the only reason why I bring it up now is because as we look at this chart, basically what the chart would tell you is that deal flow is increasing, closed deals are increasing, the total capital invested is increasing. And part of that's because of the heightened level of prevalence in private equity and transportation, specifically in the asset light space.
Yes.
Which parlays well into our next subject, but nonetheless, I think it's an important one to call out as you kind of look at the breakdown of this chart.
So private equity is consolidating that asset light space, which is freight brokerage. Let's just call it freight brokerage.
Some 4PL, but
some 4PL, but to me they're all freight brokerages. At the end of the day, 3PL, 4PL, 5PL. I'll just call them freight brokerages because then there's
don't tell a lot of PE owners that.
I know.
No,
That's okay.
we're big, third-party logistics operating companies with a big tech-enabled TMS platform. We just happen to broker some loads.
Yeah, we just happen to broker, just act like a freight
It's interesting.
broker.
It's like 75% of your operating income.
Yeah, I know, right? I know. But
No, I was just going to ask. So, JT, why do you think? Why you coming from this background? Why has private equity flooded into asset light in the last 5 years?
Yeah. So private equity's flooded into the asset light transportation space because of a handful of reasons. One, you have positive industry secular dynamics, i.e., the transportation space continues to grow. The economy is kind of dependent on it.
it's about 8% growth in freight brokered loads are growing 8% year over year for the last decade.
Yeah.
Or more, which is sometimes 4 times GDP. So
you got a growing subsector and a growing industry and a growing economy.
Growing demand for the overall,
right?
Need for the space. Two, there's the low level of capital intensity reduces the risk associated with investment decisions during the holding period. Two, the low level of capital intensity allows big leverage buyouts, which can enable these private equity firms to multiply their returns by using leverage, financial leverage. And three, the space is incredibly fragmented. So you can grow organically at a multiple of GDP. You can grow inorganically at a multiple of your inorganic growth. You can combine both of those, and then you can fuel it with a bunch of debt.
yeah,
And you could do it over a couple of year period. You can find yourself with 5x returns. Consider that a double in the ballpark.
yeah. I mean, it's a very fragmented market. The top 100 they do actually have a sizable portion of the freight brokerage market, which is anywhere from $60 to $80 billion, depending on who you're talking to.
Yep.
Right, but it's a large market that's growing very fast. There's not a lot of capital involved, right? So it sheds off a lot of cash, and basically a lot of those owners, there's a big fragment between say $20 million brokerage and $100 million.
Yeah.
There's a lot of players out there, and a lot of those players are getting up to retirement age.
Yeah.
So and then
They're
basically
looking for a cash out.
Yeah, and
The other thing is to take a $20 million broker to a $100 million broker.
it's difficult.
It's difficult, but it's also very different than trying to take a $100 million 3 or 4 PL and turn it into a $500 million 3 or 4 PL. So it's the same 5x revenue growth, but totally different playbook.
Completely different.
Totally different playbook.
Completely different. Different set of skills. I mean, basically, you can have a great entrepreneur who runs it up to 20, 30, $40 million, but to get to 100 million, it takes a completely different
You need to
playbook.
systematize. You need to standardize
And then there's something that
sales.
our friends over at Carrier Direct,
They do really well.
they specialize
they do.
in helping entrepreneurs running a $30, $40 million book of business get to that 100 million, because you have to put in sales process, you got to scale, you got to hire salespeople,
Yeah.
right? Additional salespeople,
might need to
and you might be,
implement-
they're usually naturally born salespeople,
Oh, yeah.
right? They have the charisma and
sure.
and everything to build it up to 30 million, but then you have to get other people on the phone,
Yep.
and you might not be the best sales trainer.
You might need a
out
real
there.
technology system.
Exactly,
Or not even a
right.
real one, just, something other than Excel.
Figure out how to compensate everybody, technology.
And
now
so-
you need freight matching.
Totally.
It's
You've lived it.
Yeah.
But
So if you're 50 years old, do I really want to take all that investment and go up? Or do I want this PE company that's doing a consolidation of the industry to come in and offer me, if I'm doing $30 million, maybe $10 million for my brokerage?
Yeah.
And I go open up a NetJet account and I relax for a couple years.
Yeah. Well, I bring that up for 2 reasons. One, I've the first thing I mentioned here was the supply and demand dynamic of properties. One, I bring up the thesis because a private equity firm would view each of those tiers dynamically differently. If you told a PE firm to get a 5x return, you had to help a company standardize sales, you might say, okay. But then conversely, as a past banker, knowing that you can go up to, you just mentioned a 50-year-old, founder-led entrepreneur. A lot of these guys have never thought about selling their companies.
But they haven't, no.
So you show up and you're an investment banker and you say, hey, by the way, you can keep working 75 hours a week and you can try to bring this thing to the next tier, or you can work with me for, maybe 3 to 6 months, and I can probably get you a check for like $10 million.
Yeah.
And they're like, what? Really?
Yeah.
And you're like, yeah.
Yeah. And
they're like,
what would you do, Andrew?
Depending on age, if I was any day older than I am right now, I'd take the 10 million and run. So yeah, taking the 10 million.
So, that's how you can unlock a lot of deals in transportation, is by talking to family-owned businesses who had never been traditionally institutionally targeted.
And that's a unique thing with both the asset heavy and asset light, is that the vast majority are family-owned businesses.
Yep.
Right?
Yep. And so, okay, so now you unlock the deals, right, at whatever tier. So now you've got to identify your buyer universe. And so, going to find a private equity firm that'll, if it's call it 50 million in revenue, you're talking, let's just say 5 million in EBITDA. So if it's an asset light property, if you just assume it's going to sell for 7.5, 8 times, and you're talking to 40 million enterprise value, you need someone to be able to write, call it a $10 to $20 million equity check.
Mm-hmm.
So you're talking 10 to 20 million on the low end, maybe 3 times that in terms of equity check size on the high end for this tier. And so you're looking for a firm that's going to write a $50 million check, kind of midpoint, of which there's hundreds of private equity firms that would entertain, an opportunity of that sort.
And we're talking about on the asset light side?
On the asset light side, right? And so when you're selling an untouched asset to a buyer's universe that can provide a high level of leverage and you can return a lot of growth and cash flow, you can drive valuation pretty materially. And conversely, they're able to provide that valuation because they can see tactically how you would grow the asset.
Mm-hmm.
Now, when you get to the next tier or next level of scale, let's say instead of being 50 million in revenue, now you're 500 million in revenue and your asset light. Okay, well, if you're doing, and again, I'm using totally round numbers here, 50 million of EBITDA, and you've got, a 10 times multiple, that's a, $500 million enterprise value business. If you put 3 times leverage on it, you need a $350 million equity check, right? And those guys, in order to justify their IRR, need to be able to go to their investment committee to say, we can get a 5x return in 5 years or less, even if it only turns out to be 3 or 4, right? And so they've got to be convinced that you can penetrate your way into the market to being a $2.5 billion company, which is a very different.
So that's a very difficult
strategic thought process than saying, well, how do I grow a brokerage from 25 million in revenue to 100 million in revenue?
It's hugely different.
It's kind of like go from just serving Dalton, Georgia to serving all of Georgia.
Yeah, exactly. Yeah.
Which, so you then enter this strategic discussion of like, okay, how do you become a multi-billion-dollar asset like logistics company? And this is where kind of, the private equity plays start getting really interesting. And a handful of operating companies have done this really well. And they've systematized this model, and, the names are pretty well known.
And we've seen some of those deals over the last few months. So we saw Mode Transport, Mode Transportation, combined with Suntech.
Yep.
And we've seen, Transportation Insights.
Yep.
And Nolan doing a lot of, where they combined, number one. And then that private equity firm that's behind them are doing a lot of bolt-on acquisitions right now.
So let's expand on just these two, because you bring up a really good point. And I think you deliberately went right at the heart of this, which is,
of course,
you mentioned 2 private equity owned operating companies who each did 2 deals, or, each did 1 deal respectively. And so this exactly hits on my point. If Griffin owns TI and if York owns Mode, and let's say they're into it for enterprise value of $750 million each, they're not both exactly the same size, but just for illustrative purposes.
They're close, though.
If they want to get to $3 billion each, it's tough to do that organically.
Very tough to do it organically.
Yeah.
Almost impossible.
It's really tough. So if you can go out and bolt on another $750 million in enterprise value for each of these, now you've doubled overnight in terms of enterprise value size. Obviously, it's cost you some money. And so now your organic question is not to quadruple, it's to increase by maybe 50% to find your exit.
Mm-hmm.
And so the question becomes, well, what properties can you most strategically acquire to help you accelerate your organic growth? So you not only gain scale, but you accelerate organic growth.
So if you take this one step further, you're not going to be shopping around $30 million brokerages.
Doesn't move the needle.
It doesn't move the needle unless you buy 10 of them.
It might be dilutive because, you've got Jim Damon over at Mode spending 2 days a week looking at a business that doesn't move the needle.
Exactly right. So you have to look at...
Which he doesn't do, by the way.
Yeah. So you have to look at freight brokerages or 3PLs or 4PLs or whatever we want to call them that are doing at least 200 million, probably closer to 500 million.
Yeah.
And there's not many of those out there.
No.
So now, very, very small handful.
Now you've got to be strategic, right? Because it's no longer this position where, there's 500 opportunities. I just need one.
Yeah.
It's more like, okay, there's 5 opportunities and there's all of a sudden 200 buyers.
Yes.
So the tables have turned on the supply and demand dynamics really quickly.
Very quickly,
to another. So, okay, so like, why did Mode merge with Suntech and why did TI merge with Nolan? Are they just because they had great brands? Actually, there was pretty material strategic implications for both of them. Right? They've got to move the needle in terms of TEV, but then also in terms of organic acceleration. And so both of these, you mentioned 2 really unique combinations. So like TI and Nolan make a ton of sense because Nolan had a traditional company store brokerage model matched with TI having a big transportation management platform, and they were able to cross-sell their books of business because they had non-overlapping lines of business. So TI was able to take that whole managed trans book and put it through the brokerage of Nolan and capture all that net income, or net revenue rather. Conversely, Mode and Suntech, they were sort of the 2 biggest agent-based networks in the country, and it was really challenging for them to think about who else to merge with, and so they're sort of the prince and princess of the dance, if you will. Maybe not king and queen, but prince and princess for sure.
Because, it's tougher to take an agent-based model and merge it with a W-2 broker model.
It's tough. And the reason is because your brokers can call on anybody they want.
Yes.
But I could be the agent at Mode who owns, like, the Pepsi account.
Mm-hmm.
And if all of a sudden... and so I own that P&L, so it's my revenue. And so I feel like I can walk away, which may or may not be true, but they at least feel this way because they're independent business owners.
In a lot of cases, they can because they own that relationship.
So if we purchase a brokerage and those guys start calling on my account, man, I'm unhappy.
Oh, yeah. You're going to be looking at other agents or other agencies out there to go jump ship. And that happens constantly.
Yeah, that's right. So now where's the organic acceleration? Well, Mode was really well known for their intermodal offering, their IMC. And Suntech TTS was great in dry and flat. Now, Mode also had a dry offering, so it's not to say they didn't, but it's great to rebalance out this portfolio. And if you note, Mode back, originated as an operating company or most recently was an operating company for Hub Group. So the IMC model was incubated there to a material level of scale, and that's why roughly 65% of their revenues came from IMC.
So we've talked about why private equity makes sense for the asset light players, right?
Want to go full circle?
Yeah, let's take the tiger by the tail.
Yeah.
Why is private equity not so great with asset heavy?
I think it's a much easier question to answer now, having gone through that. With the same private equity philosophical mindset, how do I look at a truckload carrier that can go through these tiers? How do I get them through these tiers? And oh, by the way, private equity firms, they all think in terms of equity check size, in terms of in and out.
Mm-hmm.
And so the same private equity firm that was targeting an equity check of $50 million for an asset light business, which might imply EBITDA of 6, 7, 8, something like that. Well, if a truckload business is trading at 4 times, I've got to find a truckload carrier that's making $12 million of EBITDA instead of finding a brokerage that's making 5.
Mm-hmm.
Right? And so
yes.
You see where we're going here?
Yeah, I know, right? It's
how long's that list?
Not long whatsoever.
not long. And so as we go through this tier, okay, so let's keep going. All right, so let's say I find my $12 million EBITDA truckload carrier. I lever it 2 times because I want to be conservative, right? And so I go 50-50 debt and equity. I write a, call it $50 million enterprise value check, 25 million equity. And now I want to double my return. I won't even talk about 5Xing. Let's just say I want to double my return in 5 years. They've got to do a bunch of M&A. You can't do that organically. Okay. So let's say you find the target. You acquire a like-for-like scale. Now you've got post-merger integration questions. Does the network overlap? Can you cross-sell the business? Do you have to call the brokerage revenue? Does the equipment types make sense? Do the dispatchers work together?
And there's another question too, right? And it applies to asset light as well. But a lot of these are family businesses, and it's harder to do due diligence on family-run businesses because everyone has an incentive to keep the bodies that are buried.
Oh,
And they do it pretty well, don't they?
and truckers got personalities, man.
Yeah.
So I merged 2 carriers about a year and a half ago. One that was about, same ballpark, and another that was a little bit larger. And man, these guys went at each other real hard. They're like, the buyer was, was sort of like, how do I know? You say you have 250 trailers. How do I know you have 250 trailers? And he's like, well, it's on our asset list. It's right on my balance sheet. And he goes, well, I want to see them all. And you're like, think about that for a minute. They're all rolling all day.
Yeah.
All over the Northeast. You know what I mean? So like saying I want to see them all like doesn't make any sense. You can't actually go count them. So like if there's no like inherent respect or there was a lot of respect, but like faith and word, that's because they're all type A's. But so this brings me to my next point. So let's say you do the merger. There's no cyclicality in the space, so you keep growing organically.
Oh, that's a big if.
That's a huge if. And let's come back to that. But I know you guys talk about cyclicality a lot, which is why I'm not touching on it. But obviously, it's a very cyclical market.
Yep.
But let's say you get to this, you've doubled in size successfully. In order to make your money, you still have to sell.
Mm-hmm. Who are you going to sell to?
Okay, now you're in my world, right?
Yeah.
So now you're talking to this fishbowl of 50 people.
Mm-hmm.
Okay. And so if you had to sell a company for $125 million right now, we won't name any names, but let's just think about that list of 50. Think about how many are public, how many are private, how many are owned by private equity.
Mm-hmm.
Okay. Go look at the news. The market's down 8% in the last 2 days.
Yeah.
So the public operating companies are going to be really challenged to write an equity check with stock right now. So they might be off the list already, just like that.
Oh, I think that's a safe assumption.
Just
that
like
they're
that.
off the list. Yeah.
And that's happened to me before, where you're in the middle of negotiating a deal with a public company and all of a sudden the public equity markets fall apart and you can't get an equity check.
Mm-hmm.
So 50s become, and really the 50s like 30.
30, yeah.
Right? And
Yeah.
so your 30s become, call it 20, super round numbers here, right?
Yeah.
So now you're dependent upon private equity backed operating companies, of which there's none buying companies at 125 million EBITDA right now.
Mm-hmm.
Okay. So take that out. So you're basically left with a group of 20 that are all family owned businesses. And so how do you get a $130 million check from someone's family office?
And I
That's
don't
the
know if you
question.
just said this, but out of those 20, there's probably 10 that do not do deals.
They don't.
They do not acquire.
Nope.
They've never acquired anybody. They never will.
Mm-hmm.
And so they're off the table.
Yep.
So you're really essentially down to less than 10, really.
Yeah. So this is where the saga of trucking gets really interesting.
Yeah.
There's the kind of like the hidden elements of getting large deals done is, you're not doing traditional deals in, New York City. You're going around the country to some unique trucking towns looking for $100 million checks, which is such an asinine statement to make.
Like middle of nowhere Iowa or middle of nowhere Nebraska or middle of nowhere Oklahoma,
Dallas maybe.
Dallas,
sometimes New Mexico, every once in a while in Wyoming, maybe in Pennsylvania or Baltimore.
Yeah.
I mean, I don't know. I'm just making up city names. I've never done this before. And so, when you talk about the willingness of those institutions, if you want to call them institutions, it's almost completely independent of the state of equity markets, the state of Wall Street, almost even the state of truckload. It's more so like what's going on with each office's sort of family dynamics that week, that month, that quarter.
Yes.
Which,
So there's no exit.
There can be, but you've got to be deliberate, and you have to understand that the whole notion of multiple appreciation throughout these tiers.
Well, there's no good exit. No good exit strategy that
there's a glass
you really
ceiling.
Want to.
There is a glass ceiling.
There's so many other industries with great exit strategies. Why would you be a private equity company or
That's
firm buying asset base?
And that's why there's so many family-owned trucking companies, I believe. So, like some of the large. That's why some of the largest trucking companies are still family-owned, because the ones that have gotten that big are usually actually run pretty well and make pretty good money and reasonable return on assets. But if you don't have an appropriate exit, then their idea is, well, you know what? I'll just hold it and I'll harvest the cash flow and I'll reinvest it in other stuff and I'll diversify my portfolio.
So last question on trucking, because we have to move on, but what's the best way to reinvest your profits in trucking?
This is a subjective personal question, but I know the answer you're looking for is real estate.
Real estate. Real estate. And I think it's very quantifiable. I think I'm going to do a survey, actually. If I can get to the C-level.
Where you can invest in venture tech companies.
It's true. It's true. but every trucking company owner from 5 trucks to 5,000 trucks I know has all their money tied up in real estate.
Yeah, and it works out pretty well for them.
It does.
But it's interesting how someone goes from one illiquid investment to another.
True. But the real estate market's much more stable. There's not the cyclicalities of it. You don't go 2 or 3 years not making any money.
Yeah.
And 9 months of just raking in the cash.
And perhaps that's part of it, is the hunt for stability.
Yes.
In a world where day by day you're dealing with a lot of volatility.
It's nice and tangible.
Yeah.
You're running a trucking company because you have nice tangible assets.
Yep.
Real estate is very nice. You can go out and walk across it. You can mow the grass.
Okay, let's keep going down this list. What's number 2?
Number two
type of business I see owned in these family portfolios are insurance companies.
Oh, yeah. So it's a very good one, too.
And it's also obviously tangentially related to trucking, because the real estate, well, if you can park your trucks there, great. The insurance, well, if I can underwrite my own premiums, I can hedge one of my biggest cost inflationary risks.
Yeah. Insurance is good.
So there's another one. What else? Large manufacturing companies.
Yes.
That happens to be another one.
Yeah, it does.
Gun stores.
Definitely gun stores.
That's another one.
That is another one, yes. They usually have large collection of guns.
Sports teams.
Sports teams, yes.
Those also come into the fray.
They do, yes.
What else? A lot of these guys invest in private equity funds.
But not ones that invest. Well, no, they do actually invest
they do.
ones.
They do.
I was going to say they're smart enough not to do that, but I guess they know the business. They know the operators. I bet you those private equity funds in trucking outperform 10x to the guys who are running franchise restaurants who decide to buy a trucking company.
I would totally agree with that.
Yeah, I would too. But so that's the end of the discussion for trucking. We ended there. We're running out of time for all our segments. I could sit here and talk about trucking and M&A for another 2 hours.
Clearly.
Yeah. We'll pick it up on another episode at some point.
Yeah, sounds good. Thanks for having me on, guys.
Yeah, you bet.
Thanks for coming.
You bet. Well, you
can hang out if you want. I mean, we just got a couple more segments. You want to run through them?
We're going to talk about the drug.
Yeah, no, we're just going to
Take
talk drug and alcohol clearinghouse. It started January 6th. We've been here for seven weeks now. It's been implemented. Over 8,000 positive tests in the bank so far on 650,000 registrants. And
That's only 10%.
yeah, right. One of the guy, what's his name? The CEO for Driver Recruiter, Driver Reach, believes that 90% of new drivers applying for jobs have yet to register. So that's a
Now,
very
is this
small
all
subset.
CDL?
But it's all
Did you-
CDL. Yes,
it's all
if you have
CDL.
a CDL, you're supposed to eventually
Yeah.
have to register for this.
So Dooner does some math on this, but you're an engineer, so if 90% of the drivers haven't registered yet, and we're 10% already have, let's say in 2 months, 8,000 infractions or
Positive tests.
positive tests. What, if you extrapolate that number, what do you get to? Are you going to pull out your iPhone calculator?
Yeah, I was going to say, what are there? 3.5 million drivers?
Yeah, about 3.5 million drivers.
Right.
I think this is all Class 8 CDL.
I think
That's
so too.
one of the things I need to confirm.
This is the way I would go about this.
But you have random drug testing that last year was 25% of drivers. Now it's 50% of drivers. So you're going to have an acceleration.
So you have like 3.15 who haven't been tested yet, and you're saying what's the
8,000 so far in 2 months.
wow?
So I mean, is that
8,000
really?
over 400K?
So if I do it in my head, it comes out to a number that really can't be right.
Oh no, I mean, Dooner and I just like on the back of our envelope during FreightWaves radio said, let's say it's 8,000 in the first 2 months. If it's only
So let's say
all it's gonna depend on-
100,000.
all of it's going to depend on if the rate of failure stays the same through
Yeah.
the first 10%, which it likely will not. I think it's actually going to fall over time as more drivers see their buddies get positive tested or they see news about it. I think they'll eventually be smarter about using or won't use at all, hopefully. So I think the percentage of failed tests will fall over time.
Because this run rate's like 100,000. And then if
Yeah, it's like 80 to 100,000.
or 9 times, I mean that's almost 1 million drivers. I
So-
mean, it can't be right.
Now, your hypothesis on why the failed test rate will drop, if that's true, it would also positively correlate to drivers exiting the industry.
Yeah.
Yes. Oh yeah.
Yes.
So whether or not they fail a test based on your hypothesis wouldn't matter because either way they're leaving, which, if we're trying to track capacity or
Based on
True.
supply.
Yeah. Are you going to leave before you test
Right.
positive?
Like we don't care if you test positive or not. We're just trying to track trucks on the road rolling
Mm-hmm.
from
is true.
like a revenue perspective. So
Yeah, I guess that's the decision for a driver. Is it going to be, am I going to get out of this industry before I fail a test, or am I
Right.
going to get clean and not fail the test?
Because
Really?
if you fail a
Which-
test and you try to get another job somewhere, and they, basically the new employer has to check that database,
yeah.
then they can't hire someone who has
Yeah.
failed a test because if there's something that happens, nuclear
Really?
verdict.
Yeah.
on
Really,
and
the
on.
question to ask is this initial sample representative of the whole sample?
Correct.
That's the
True.
question to really
True.
try to figure out, and I have no idea.
Yeah,
how
I
to
mean,
dissect the
10%. I don't
select-
think
I don't either.
Is it enterprise fleets or owner-operator self-selecting?
It's a combination of all of those. So I don't have the breakdown, but I think we're going to do research.
That'd be the way to think
Study
about
on
it,
it.
right? Because if it's enterprise fleets, they could either be testing the guys they know are going to fail or the opposite,
Mm-hmm.
depending on what they're trying to accomplish.
Well, it's random testing. Right?
Okay.
So basically, a third party is going to do the random testing. It's going to be at arm's length.
Yep.
But if the enterprise fleets are trying to hire drivers and they're in the drug clearinghouse database, they can't hire them.
I just want to know how honorable the third party is going to be. Is this going to be like the NCAA or the NFL
No,
testing
there's-
players, and it's like, yeah, test these guys. We
Well-
know these guys will pass, or we know these guys will fail.
No,
Like the same way that
Right.
Depending on
Usually
what your
they don't
goals
have
are.
any that they don't have any
Got no skin in the game.
control over who gets tested and who's not. I think that would be a huge red flag. But it's something curious. I think we're gonna. I was gonna wait until the end of the first quarter and take the numbers and do that. But I think this is a big enough story to actually start at the end of February. Take the first 2 months, and then we can revisit it maybe on the 6 month mark. But I think we need to get
see how close we
this
are.
out. Yeah, definitely.
Well, cool.
All right.
Yep. Drug and alcohol clearinghouse. That's it. We're gonna move on to the DHL supply chain pricing power index. This is again our kind of our own measure of pricing power between carriers and shippers throughout the entire U.S. We synthesize a lot of FreightWaves indices to come up with this, as well as some economic data. 0 would be full power to the shippers, 100 full power to the carriers, 50 being a balanced market. Right now, we fell another 5 points to 20, so almost full power to the shippers.
Yeah, we're sitting here in February. The volumes over 2019 are flat. They're under 1% growth. Capacity, the outbound tender rejection rates are back down to the mid fives. Same thing we saw in 2019. So with that, I don't know. It's basically a shipper's market right now.
Yeah, the next few months are going to be really interesting for me because one, this looming coronavirus, we don't know what the impact are going to be to the U.S. supply chains. It seems like things are getting worse and worse every day. The CDC came out today and said expect a community-wide breakout of the coronavirus.
And if you sit in the corner of our, if you sit in our corner on the FreightWaves floor, you are prepared for the worst case scenario because that's what everyone talks about is the worst case scenario over and over and over again all day long.
Yeah. So, there's just so much going on when this drug clearinghouse coming in, you have insurance rates through the roof, you got company failures up, and at the same time, you may have this massive influx of volumes off both coasts here in May or April. I mean, it's going to be May, April, and June. It's going to be really fun. I think
it's going to be a fun, volatile market to watch.
Mm-hmm.
Yes.
Yeah, because I'm so sick of this broken record. Every week I'm writing this PPI. It's like, volumes are flat, capacity's the same,
right?
Rates are down every week.
I know.
Same thing over and over. So yeah, I'm ready for some volatility.
But we know how to say volumes are flat.
Be careful what you wish for.
I know.
Well, here I was saying the same thing about the stock market, and then here I'm down 10% in 2 days.
Yeah, I know, right? Yeah, but we know how to say flat. The market is flat. About 20 different ways now.
I write a dictionary on how to write volumes are flat. Okay. Last segment, we got the long short. You were just introduced to Robinhood.
Yeah.
What was it, 2 weeks ago? So you may not know, you may not be able to speak to this one, but we'll ask anyway. So Robinhood, the free stock trading platform that's just blown up all over the place. They're still a private company. There's a long kind of look out to an IPO either this year or next year. People are very excited for it. But E-Trade was just purchased for $13 billion, and we have a lot of data on them. So we get a little bit of comparison here. Here's the rundown. So Robinhood has 10 million users, that's twice that of E-Trade, but Robinhood makes much less per user and has far fewer assets under management. Again, most of the guys on Robinhood are like us boys upstairs. We got a few $100 in there. We trade every once in a while. We don't do much. And they've had a difficulty kind of keeping people on the platform, get stickiness because of everything so free and yada, yada. But something they're going to introduce very soon is a social feature. So imagine, I don't know if you know about Wall Street Bets on Twitter or on Reddit or StockTwits or any of these different social platforms where people share stock ideas. They're going to try to integrate that into Robinhood and create their own to create kind of more of a social environment behind the Robinhood trading. Long or short, that idea?
I would say long. I mean, I think there's a large propensity amongst individuals to have more leverage to the financial markets. I think Robinhood's providing that from what you guys have told me through really low margin, which is highly risky, and I'm not necessarily a promoter of it, but I believe there's a market for it.
Yeah.
And if you combine that with a social play, I think it helps more deeply penetrate a lot of different generations. And even if that only serves to act as free marketing, I think that's pretty impactful. And furthermore, the appetite of capital financial markets to invest in high revenue growth, high risk assets, with no capital intensity is massive right now. So you put all that together, I'd say I'm long.
I would be long. I am long the idea of community, right? Because basically it's the same thing. You get a bunch of gamblers in a room. It's very entertaining. I'm short on using the community because I hear enough about stocks and stock picks on a daily basis to
buy bonds.
Yeah, to buy bonds, right? To get out of the market and just buy gold or something. Because golden guns. Yes, definitely. But I hear enough. I hear enough stock recommendations on a daily basis to to do me for a lifetime, I think. So I'm not going to be an active part of that community, but I think it's a really good idea.
Yeah, you wonder why I borrow your headphones every day.
I know,
It's
right?
not to listen to music; it's to drown out the boys up there. I'm long as well. I think I'm long the idea of this. I'm not long myself listening to anybody on there because I spend enough time, even if it's 10 minutes a week, on Wall Street bets. I see those idiots make $40,000 and then lose it in 10 minutes. So I won't be listening to anybody there, but I think it is interesting and I like it for Robinhood moving forward because I like Robinhood.
If you are into the YOLO culture, it is great for you.
Yes.
Great for you.
Let's
And
explain
YOLO,
that, by the way. It's that you only live once. It's the type of next day calls, out of the money calls that are never going to hit, but you do it, 150 times. You might hit one and you make
do it on
money.
margin.
Right. Exactly.
You use margin to do it.
Yeah. Robinhood's a scary thing, but it is fun. Okay, the next one is actually a story we got that you guys talked about, you and Zach talked about on the Freight Update, and that's the e-Cascadia, this new electric truck that we spoke to a driver in California that was running drayage. I can't remember from what port, but he was driving like 100 miles a day, and he was singing high praise for the e-Cascadia. He was saying that there's basically no noise to it, there's no shaking, it doesn't really affect his body at all. It's a much better driver experience, and he says he does not miss the smell of diesel or anything that goes into his diesel truck. What do you think about this praise?
No, I'm long this. I'm very long this. Clarissa Hawes, one of our writers, wrote the story. You can find it on FreightWaves.com. And basically, there's a couple things. It's all electric, and basically the acceleration keeps up with traffic and the stop and go because trucks getting from stop to go takes forever.
I'm one that cuts right.
Cuts right. I am too, actually. But they can keep up traffic. I think that's going to be the first iteration of electric trucks or local, 100-mile radius, one charge per day, and I think it's I'm very bullish on it.
I think it's an interesting play. I think the electric angle is one that will continue to grow over time. The real question is charging stations.
Mm-hmm.
But I think if you're doing it, I think starting with drayage makes a lot of sense because it's local-ish moves, if you want to call it that. And so if you can keep it in a radius,
I think it's an 8-hour charge. So if you can keep it in that radius, doing an 8-hour charge every day, I think you can build enough scale to it to keep it going. Maybe you get charging stations in the future. Maybe it leaks over the road, but they'll probably be in years. But that's a great first place to start is those local moves.
Yeah, I think Dre makes a lot of sense.
Yeah, I echo what you guys are saying. My biggest takeaway was
I would fall out of my chair if you went short.
Yeah, I mean,
any electric vehicle, I would.
Yeah,
I would completely fall out of my chair,
the,
and I don't even have room to.
Yeah, if you fell, you might go through the glass.
I might, yes.
Yeah, I mean, I like the driver experience. To hear this driver that he's loving it. You hear the same thing from people that drive electric cars, that drive Teslas, that they love the experience of it being fast and quiet and no shake. So to hear that it's happening on a big rig scale, that's good. I'm excited for the future of electric trucks.
I am too. I am too. Well, that wraps it up for this episode. It's been great. Great M&A discussions on both freight brokerages or 4PLs or 3PLs.
Whatever you want to call it.
Whatever you call it. And then your traditional trucking and drug clearinghouse and electric vehicles. Thank you very much, JT, for joining us.
Thanks
and please come on again soon. And again, that wraps it up. And I guess we're out. Should I do the music again? I never know with the new intro.